Hello and welcome to Panther Financial Services. This is Pranav Patil. Today we will discuss how Silicon Valley Bank collapsed and is it possible this kind of event in India? What are what is the main reason behind it? Is it the Fed accountable for this entire mess or not? We will discuss these things as well. So let's start with the discussion with a few facts that say the Silicon Valley Bank founded in 1983 in California only. Uh, the current CEO is Mr. Greg Baker. That if you look at the total assets of this bank is $216 billion. For those people who are not able to grasp the entire amount, is equivalent to almost ICICI Bank has a $220 billion assets, whereas the HDFC Bank has a $280 billion assets, whereas SBI has $650 billion assets. So you can uh, understand the kind of the size of the bank basically. So this loan, the loan book for this bank is almost $70 billion. If you look at the EPS, earning per share of this bank is $25.35 per share. If you look at the net income for this bank is $1.5 billion, and return on equity is almost 12%. If you look at the fixed income investment of this bank, it's close to $124 billion, and deposits standing around $170 billion plus. So just imagine if you any guy, if any financial guy or any research guy, if he sees these details, you'll say it's absolutely good bank. Then what is the issue happened? If you look at the before the share crashed of this bank, the one day before, if you look at all the things were normal, almost 70 to 90% research firm was saying buy this stock with a target of 30 to 70% upside. If you look at the Moody's rating for this bank is A3 plus, A3 plus Moody's rating. So even if you would have thought, let's say I wanted to invest into fixed income, what to as a secured investment, you would have by default you would have selected this. Now, how basically bank works? What is the USP for this bank? They give a lot of loans to startups, and they have a lot of accounts of venture capital funding as well, venture capitalist. Now, the model, we are not pinpointing their model or anything on that basis. What we see, there are major two reasons for this entire issue is lack of communication from the bank side to the media and to the shareholders, and the second is unexpected interest rate decision by the Fed. Because if you look at it in a less than years, from 0%, the Fed is targeting 6% in a less than year. This is unusual movement of interest rates, and that is leading for the banks to bleed. Now, this could be, if this is the one incident, if the Fed doesn't start this kind of thing, if Fed doesn't stop this kind of things, then it may, turn to other banks as well. And the other banks are already started. I'm talking purely in the US. They have started taking up precautions because their expectation were max Fed may go to 4%, not more than that, or 3.5% interest rate. But the Fed is targeting now 6% interest rate, 0% to 6% in less than a year. It is unusual movement in the interest rate. In the last 20 years, we have not seen this kind of things. And this is what is happening. And because of that, it is, impacting the other things as well. Now, Fed is not wrong. Fed wanted to control the inflation. From their perspective, they are absolutely right. And the chairman is very bold. Somebody, need a board people on this position to take this kind of decision. From their perspective, they are right. The bank perspective, they should communicate it properly, and they would have taken the decision. But they taken the prompt action at the right level to avoid this kind of things. Now let's talk about the what exactly happened. So if you look at the bank's employee total size of this bank, 8,540 employees works in the bank with the average pay of $250,000 plus, which is very good pay. In terms of INR, it's a 2 CR. Now, what happened the day the news came, the share crashed. Before 1 week, of this, the banks came in the market stating that they wanted to raise 2.25 billion dollar to ensure the smooth functioning of the bank. This is the first news came. Before that, the CEO of this bank sold his shares into the market. Now, when the news came into the market, but as a research firm, you may think that okay, the bank has a, even the layman manner will think okay, bank has a 216 billion dollar in assets, bank has a 174 billion dollar fixed income investment, bank has a loan book of 17 billion dollar. Then what is the issue? Bank should work, properly. Why they do? Why they require extra fund from this? So what happened? What they have done, they have invested money into fixed income investments, mostly into US treasuries as well. Now we will discuss the what is the risk into the fixed income or the bond. I'll give you a very simple example. 1,000 rupees is the par value of one bond. Coupon rate of this bond is 5%. Coupon rate means at what interest you get the money from the bank to the investors. Now the term for this bond is 10 years, and YTM, that is yield to maturity, is 5%. Assume it, this is the example we are taking. So the what is the price of this bond? What will be the price of this bond? 1,000 rupees. Yield to maturity is nothing but how much exactly the bondholder will get the money looking at the current market rate. This is the one scenario. If I invested 174 billion into bonds and the interest rate is 5%, my price or my valuation will be 174 billion only. Sounds clear? If the interest, there is no change in the interest rate, there won't be any change in the valuation of the bond. So always remember, if any changes in the interest rate, even the expectation will change the return on their bonds. So now this is the first example we discussed. Now second, just assume it that interest rate went up. The Fed has increased the rate, so in the market also interest rate will go up. So for this bond which was giving a 5%, now the YTM, the coupon will be the same. The par value is 1,000 rupees. The term this term is 10 years only. The coupon rate is 5%, and the YTM is gone to 6%, 1% upside. What will the price of this bond? 926.40 rupees. There is a separate formula, you can check on the Google as well. We are not going into the details. Now how come 926? The price should be 1,000 only. The reason, because every year 5% you will get from the issuer of the bank. Rest 1% of that difference you will pay. You don't have to pay. It will be reduced from your par value. So if you look at it, 926 minus plus 74. So what is the portion? It's somewhere around 8% plus. So at the initial level only you are removing that portion. You are not paying that 1%, because rest 5% you will get it every year. So and 1% you have already not paid. So net your return from the bond is 6%. I hope very clear on this part. Now this is what exactly happened. The bank investment were in FI investments, and few people got this news. The big venture capitalists, they tried to pull their money from the bank. If you look at the news came on Tuesday. By Thursday, almost $42 billion withdrawn from the bank. The big clients, big venture capitalists, they withdraw the entire money from the bank. Now, if I'm VC or any depositor of the bank, I will just initiate the request, I want my money back. Now, what is the job of the bank? They have to give me money. They can max say, okay, we'll give you money tomorrow if the amount is big. What they do, they have the money, right? But it is in the investment form. They have invested into the fixed income bond. Now what happened? Because the interest rate has gone, the price of the bond has gone down. If they sell it at this price, the bank may face the loss. Now what is happening? The Fed is not stopping interest rate, they are taking up only. So it is again getting hammered on the valuation part. If you look at, to beat that current demand of the depositors, they were withdrawing that amount. To pay that, they have sold securities, fixed income securities, and they booked the loss of $1.85 billion. Now if you look at the overall dent, the fixed income investment dent, basically price, what is the deficit in the firm? It is close to 17 to 18 billion dollar. Now what is the income of this bank? It is, if you look at the last year's income, is 1.5 billion dollar, which is 17% down from previous year. So now if assume it that even the news came in the market and the depositor went to bank, okay, we want our money back, that's it. So bank has to sell that investment to pay back their to depositors. So if they sell it, they will book the loss. So assume it that they book the loss of 18 billion dollar. Now how much time bank will require to cover that loss? Close to 12 to 15 years, and that also with a with the assumption that they have all the investment in place, they have all the deposits with them. If this kind of things happen, the deposits are going, back from the bank, then they won't be able to earn this kind of profit. And this is what happened. In the less than 48 hours, the regulator took a decision by shutting this bank. Just imagine if we have this kind of things in India, what our regulators will do in 48 hours. We last few weeks back, we got a news of big businessmen were having some issues. US short seller gave a report on that. What our regulator took a decision, just imagine. It's been a month's time and still we don't see any comment from the regulators, whereas in the US, in less than 48 hours, they studied the entire bank, they took a decision. There is no other way to save this bank, let it shut down. Now in the US, if the bank is shut down, closed, then the depositors. Now in India, if you deposit any amount in the bank till 5 lakh is insured, you get back that amount. Similar case in the US, it is 250k, that is almost 2 crore rupees. Your 2 crore rupees are insured. Rest money, you may get it or you may not get it. If you look at the and the entire things, the decision took by the even the Federal Deposit Insurance Corporation has decided that, and that decision was in less than 48 hours. They have clearly stated in coming 3 days they will ensure that the uninsured amount also they will pay back to depositors at certain level. They have not stated how much percentage they will pay, but they stated that they are going to pay that. Now the entire issue happened, the unexpected interest rate went up, that led to the valuation of the bond, and indirectly it was not properly communicated by the bank to the shareholder in a right manner. Few people got this news, they asked money back from the bank didn't had any option rather than selling the investment. They book a small loss. The entire news came into market, the panic happened, the share crashed, and it came in the news, the regulators came in the picture, they shut the bank. It is as simple as that. Now this kind of things won't happen much in India because we are not that dependent, the banks are not dependent on the investment section part. What they do lending to the other parties. You must have seen that a lot of cooperatives bank RBI is shutting, or they have put the restriction. The reason, because they have given the huge amount of loans and there is no recovery. So in our case in India, we see the issues from our other side, not from the investment side or not from the decision perspective side. So this is all about the news about the issue. And it is my suggestion, if you see this kind of things, just try to be relaxed. This lot of people claims that it is 216 billion loss. Absolutely not. Somewhere around 20-25 billion will be dent, the net debt after paying everything, and that will be absorbed by the few people, the good people. are the those who have a good deposit and they know how to get the things done. So hardly there will be a few weeks, you will, but 1 or 2 weeks max, you will find the news in the market, and then hardly nobody will remember this kind of things. Hope you enjoyed today's statistics. If you have any doubt on this, you can mention in the comment box, or you can WhatsApp me anytime. Thank you for your time. Have a great day ahead. Thank you.